Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the FSC show, we're going to talk about the activity, rigs, what's going on, but we also want to look at Golden Week in China. How is that progressing? Is it good or bad in terms of the activity? Then we also want to touch on international refined product storage, and then look at the U.S. consumer and some of the data. Obviously, the market is down after the JOLTS data took us up 100 handles. Now the non-farm and payrolls data is taking us down. It's all built on rates, which is what we talked about in the econ show. And this is really what we called for in terms of the pain that we expected coming. Now, before we get into the FSC show, we want to touch on Iran. The protests continue to rise, using the rallying cry that this is a revolution, and really touching on the atrocities that have happened to women. And realistically, there's a lot of things beneath the surface. But when you look at the rallying cry, a lot of these revolutions grab onto something, and you never really know what is going to be the rallying cry or that event that is just too much. Like, when have they, because women have been abused and beaten and arrested by the IRCG, by the different entities that try to enforce their form of Sharia law. So it's just, it was the right place, right time for all of this to start to culminate. And this is going to be something to watch when you look at Iran and how that it could pivot some of the things on the ground, as we wrote about in our Iranian piece last year. And we're going to do another write-up for next week in terms of some of the things to watch on that side. So with that being said, getting to the frac spread count, we had an increase of 1. We went from 290 to 291, and it's really all of the places that you would like to look. And one of the interesting things is this is one of the first times that we've had all but 3 areas with activity, and it just shows that we're starting to get some of that creep back. And one of the big important pieces that move from 290 to that 300 that we've been talking about is going to come on a lot of the smaller basins. Because remember, we track so many different pieces, and when you look at our competitors, they're way below us. And the reason why is because we follow the mom and pops that might only have 1 or 2 spreads. We follow the smaller basins to help people plan, and that's where we add value versus some of the others that are currently out there in the market. And then we provide a significant amount of data behind that if you're a part of where you get our full mock-up on the data side, in terms of millions of lines of rows of things that you can use to, again, do your own planning as well as see the activity. So based on everything that we're seeing, from commentary on the ground, we don't see any real shift at this point in time in terms of any slowdown. All of it's moving up. The San Juan, some of these others have seen some sizable increases. Again, relatively speaking, a sizable increase in the San Juan is not the same as the Permian. But again, those are things that are going to continue to drive things higher, continue to see that activity pick up. And now that you have the White House, which has come out and said that they want to support and move forward U.S. Oil and gas drilling, we should start to see a little bit more activity start to come in, especially if we get some sort of support. Not saying it's going to be huge, but some sort of support coming forward. And as we talked about with the commentary around the banning of exports of either crude or else. So if you think about just structurally speaking, the shortages for especially diesel is in pad 1 and pad 2, while pad 3 is fairly normal, but there's no easy way to get into pad 1 outside of 3. So you have the Colonial Pipeline, 1 and 2, which is maxed out. Jones Act vessels, expensive, or rail, even more expensive. So how are you going to move product from point A to point B when you know where the shortages exist? So what Pad 3 can do is try to capture some of that international market, take away some of that demand so that when international imports can move into the Atlantic Basin from Asia, the Middle East, it brings prices down, or at least caps prices to a degree where then Pad 1 can then purchase. Because if we were to ban exports of refined products, well, it would just build up in Pad 3. There'd be no way to get it to Pad 1. And because you took away our exports into the international market, well, now they're going to have to go out and replace it, which is going to drive up prices, which then raises prices for the East Coast. So again, you're not solving anything. Then if you were to ban U.S. Crude exports, well, our refiners operate on a 33, 34 API, and you're banning exports on things that range between 41 and 47 API. And we've already maxed out the amount of light sweet we can run. So you're still not helping anything. You're actually hurting the market in terms of taking away these exports that are going into Europe. So again, it's a matter of, and I know they're not doing it. They're throwing it out there. But there are ways that we can address this, and neither one of those are the right answer. And we're happy to sit down with anyone who's willing to listen so that we can discuss ways to address this. So then when we look at rig activity, you can see that the oil came down by 2, gas by 1, but it was all directional. Directional rigs went from 46 to 41, but horizontal rigs went up by 2. And again, the horizontal is the one that we hone in on the most, because that's where we see a lot of the biggest driving forces when you look at activity and how that's going to continue to move at a fairly stable clip. Now back to the OPEC cuts. So when you put all the math together, the actual OPEC cuts come to about 850 or so thousand barrels. But it's important because the UAE and Iraq more so longer, and they haven't been very good at maintaining, especially Iraq, their cuts. But the UAE has actively, I don't want to say ignored, but has been producing above that just because they're in a position where they can, and they have the ability to do so. They've been able to keep prices a bit lower than Saudi pricing, which has helped them be more competitive. So again, what we're assuming, and we're going to hold to at this point, is that we expect the cuts to be about 750,000 barrels, not that 850,000 or so, based on some of this math. And again, it's all fungible because we're talking about supply. So if we're running 97, 98 million barrels a day of demand, well, you don't have to see a huge swing in demand to offset some of these cuts. At the same time, you don't have to see a huge amount of demand to make and change the balance. Where if China were to all of a sudden say, you know what, the zero COVID isn't working, everybody back to work, you're going to see a sizable increase in terms of that demand, at least in the near term, and that's going to again make a much bigger pivot. So these are going to be important things to watch. China has taken the advantage in terms of some of the pricing in general, and they are back to a seasonally adjusted high for tanker movements, which we're going to talk about, which we talk about in our insights, and we're going to talk about more next week. But these are some of the key pieces that we want to look at when you're discussing some of these different moves. But again, right now, given the activity from OPEC, given where we sit, there's enough to kind of keep us here on the physical, on the paper market. Physical market softened up just a touch. We had some prices coming down, but as we said last month, a lot of these guys started high with some of their prices and then walked them down to find some of the, where are we going to find these buyers, and that's what we see playing out right now, as floating storage still remains elevated. Then also, it's interesting because when you look at Germany, industrial production in chemical and pharmaceutical sectors, you can see just how low that activity is. And they call it a surprisingly successful transition in terms of natural gas consumption of German industrial customers. But you can't maintain an economy off of this. I mean, we've already seen PMI collapse. We've already seen their data collapse. Again, we talk about this more in the Econ show as well as our insights. As any of this comes back online, you're going to see a shortfall exist quickly. And how do you try to balance that, given the situation, given the shortages, and the tough area for the LNG side? There's only so much gas to crude switching, and then that's going to make them rely more on coal. And again, there's a lot of problems when we look at these underlying situation, especially when you look at gas oil. So gas oil in Europe, I mean, it's still lowest, one of the lowest it's ever been. So even if you were to switch from gas to diesel, well, what is diesel going to cost? And then when you marry that with the carbon credits that you have to buy to offset, you're still in a very difficult position, which is why they've talked so much about natural gas storage, which is fine, and it's well above normal. But you shut down how much of your economy to achieve that. You know, you've cut demand by how much, and what happens when you try to turn it back on or try to normalize. That's where you get a lot of these issues. Then at the same time, when you look at Singapore, you know, there's another big gasoline build. You know, when you look at middle distillate, smaller build, but gasoline is going to be the problem because right now the distillate crack has to carry the gasoline crack. And if the gasoline crack gets weaker and weaker, well, now you have a refiner that's losing money. And even though the distillate market is okay and it's strong and there's demand for it, well, you're still not making money. So then you start seeing run cuts. Then you start seeing economic slowdowns, and that becomes a much bigger problem. Now, when we look at what is happening in China, and this chart is going to be hard to read, so I apologize, but I can walk through it in the sense of, you know, according to the Bloomberg in general, you know, Golden Week is falling short, and there again there was moderate expectations, but even the moderate expectations, it's falling below that. So here's a quote: high frequency data covering China's National Day holiday in the first week of October douse any hope that consumption is steadying. Passenger rail traffic and cinema box office revenue plunged. A skid in home sales in the first 3 weeks of September added to the weak picture. Providing a positive offset, production and construction activity picked up. So again, there's a little bit of that balance, but the bigger issue is consumers. You know, the construction side, some of the industrial side, okay, but the consumer continues to weaken. So the consumption gauges were particularly weak. Cinema box office revenue in the first 6 days of the holiday plunged 65% from the comparable period last year. The daily average number of rail passengers sank 38% to 6.85 million in the period between September 28th to October 8th, according to official estimates. So again, there's a lot of those issues that China's not snapping back, which is going to again hit the demand side. So when you look at the cuts in general, we're in shoulder season, there should be builds, but what is that going to do when you look at, again, that when as we come into the winter months where demand picks back up? Now, when we flip to the U.S. data, the non-farm payrolls were expected at 255, came in at 263. Private payrolls were expected at 275, came in at 288. So again, we're there. We're fairly normal, you know, and this is what, when you look at the Fed data, and we'll look at some leading data going forward, this is why we've been saying there's no opportunity for them to cut rates or slow down. You know, JOLTS is one piece, it's one leg of the stool, as we said, but there's multiple things you have to look at. This being one of them, causing this big reversal. Then when you look at labor participation rates, which we talked about in the Econ show as the issue, participation rates came down. That is a huge problem because yes, openings may fall, but you're not bringing people back into the labor market. So if they're not coming back into the labor market, even if openings come down, you're still going to have wages elevated. You're still going to have a lot of competition, and that's what they're trying to cool, and they're struggling to do so. Average hourly earnings came in right in line, which if you think about the prior, it actually came down. So yes, it's there with estimates, but you're weakening on the earnings side as inflation is accelerating again. So again, you're in a position where wages are going to have to continue to go up to compensate for inflation, again, which leads to the wage spiral, which is what they're trying to avoid, creating a lot of these problems. Wholesale inventories continue to move up. And then we started filming this after the data came out, but consumer credit in August rose 8.3% at an annual rate of $4.68 trillion. Again, all of those moving to records. And the problem on why that's moving to a record is when you look at personal savings. And for those that have been following us, we've been saying that some of the data out there on personal savings has been overstated and wrong. Well, now we found out that it was wrong, and it was wrong by 300 billion. So it may sound like a small number, but it's not. And when you take the revisions into account, you see just how quickly that money and that excess savings disappears. Now then you take in, again, income slowing, inflation going up, you're going to see that move down that much quicker, which is why we think that that we're at a pivot point right now in October where consumption is really going to diminish. Then when you look at leading indicators, obviously we do see that hiring plans are slowing. Data is going to get worse, but it's going to take time for that to happen. And those are the things that we continue to see lagging in the system, especially as you can see here, participation rates remain very low. Then when you come out to the aggregate, here you can see that for the key period of, the key number, if you will, of that pivotal 25 to 54-year-old participation rate, 82.7%, still below pre-pandemic levels. And that's something that is, again, going to, even as JOLTS come down, you're still not at those levels, just like we talked about in the Econ Show. We cover it a bit more in depth with a different kind of set of slides in the insights, which, again, shows some of the pressure and why the Fed is not going to stop, at least right now, and we still don't see them cutting in 2023. So that's what we have for you. If anything, they'll pause, but again, I don't think that we're going to see this big rewrite to the downside. So that's what we have for you today. If you have any questions, you can find us in the comment section. You can find us on Twitter, and we hope you have a great weekend. Oh, and for those that have off, enjoy the extended weekend, be it for Columbus Day, Indigenous Peoples Day, I believe it is as well, or now, depending on the shift. But regardless, enjoy the long weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.